Every pullback has been a great opportunity. Last year, the tariff-related drawdown was on April 7th, turned out to be one of the best entry points in the last 5 years for anyone buying stocks. There were so many stocks that made new all-time highs, but really explosive rallies. So I think this year, if what we think happens, it's going to be a great buying opportunity. Last year, investors did a fire-ready aim. Whenever they saw the tariff conversations escalate and become uncertain, the market really reacted poorly and fell sharply. I think that this year markets are going to be a little more measured. So let's say it's half the amplitude of reaction. But then there is still the uncertainty of how the Supreme Court will rule around the tariffs. And maybe if that rules against Trump, it's going to look like the leverage of the U.S. has dropped, and so the White House might take more extreme measures. That could cause greater uncertainty.
Markets don't panic in a vacuum. They panic when uncertainty becomes policy. And that's exactly what investors were forced to grapple with this week after President Donald Trump escalated trade tensions in a way few were expecting. A sudden 10% tariff threat against key European allies, explicitly tied to pressuring Denmark into selling Greenland, sent shockwaves through global markets. Wall Street suffered its worst single-day decline since October, with the S&P 500 down more than 2%, the Nasdaq sliding 2.4%, and heavyweight tech names like Tesla, Nvidia, and Amazon shedding billions in market value. Crypto didn't escape the damage either. Bitcoin has dropped nearly $5,800 since the announcement, and more than $215 billion has been wiped off the total crypto market cap. Meanwhile, capital fled risk entirely, pouring aggressively into gold and silver, both of which surged to fresh all-time highs as investors rushed for protection. What makes this moment especially important isn't just the size of the sell-off, but the behavior behind it. This wasn't reckless leverage being flushed out or euphoric positioning collapsing. According to Fundstrat's Tom Lee, institutional investors are still not aggressively bullish. Instead, markets are reacting to uncertainty layered on top of uncertainty, trade wars, geopolitical pressure, legal questions around tariffs, and an increasingly unpredictable policy environment. Lee has long argued that these kinds of pullbacks historically create opportunity rather than signal collapse. But even for someone known as Wall Street's permabull, the current setup is forcing a reassessment. His outlook for 2026, once defined by confidence in resilience and continuation, now carries more caveats, more conditions, and more unanswered questions. And that shift alone is worth paying close attention to, and that's just the beginning. In this interview, Tom Lee also breaks down why gold has surged to record highs, why crypto fell out of sync, and why Bitcoin's next move could define whether this deleveraging phase is truly behind us. He even outlines what has to happen for Bitcoin to reach his $250,000 target, and why 2026 may be the real stress test. We'll also look at a recent move by an insider Bitcoin whale that could be signaling even more turbulence ahead for crypto this week. So if you want the full picture, make sure you like this video, subscribe to the channel, and drop a comment below. Do you see this tariff shock as a buying opportunity, or the start of something much bigger? Thanks, and enjoy the video. If you're serious about building real long-term crypto wealth, then you need more than just an exchange. You need structure, security, and smart strategy. And that's where iTrustCapital stands out from the crowd. iTrustCapital is the platform designed for investors who want to grow their crypto tax-advantaged portfolio while having full control. With a self-directed crypto IRA or their premium custody account, PCA, you can invest in 80-plus top cryptocurrencies, physical gold and silver, and trade them all 24/7, seamlessly, safely, and simply. Here's why thousands of crypto investors are making the switch. Tax advantages that help you keep more of your gains working for you. 1% transaction fee and no monthly fees, cost-efficient wealth building. Institutional-grade custody that puts asset security first. 24/7 trading access to all supported assets. Multiple funding options. Rollover, transfer, ACH, and even in-kind crypto transfers. Fast setup. You can sign up, fund, and start investing in minutes. And this part is important. iTrustCapital eliminates the slow, outdated, and overly complicated systems of traditional IRAs. No more paperwork headaches. No more friction. Just a clean, easy way to move your money into the assets you believe in most, safely and legally. And here's a great perk for getting started today. When you sign up using the link below and fund your new iTrustCapital account, you'll receive a $100 funding bonus. It's an easy boost to kick off your investing journey. Just use the link in the description to claim it. So if you want your crypto strategy to scale into something bigger, smarter, and built for the future, check out iTrustCapital through the link in the description. It's the platform designed for investors who want to grow, not just speculate.
Let's touch on gold and then crypto. Why did gold perform so well last year, do you think?
I think there's some very visible reasons and some invisible reasons. To me, I think the visible reasons for gold doing well is one, I think that there's a lot more political and geopolitical uncertainty in the investment environment because we have wars taking place. And of course, we have a president in the U.S. that I think has actually done a good job on the economy, but has raised divisiveness and uncertainty about trade globally. The second is that global central banks are generally easing. And in the U.S., we're finally getting an easing cycle, including QT ending. Mm-hmm. That should support gold. The invisible reasons are, number one, I believe Tether, which is the largest stablecoin provider in the U.S., has become the largest private buyer of gold because Tether is already sufficiently collateralized with Treasury backing every stablecoin unit, but they generate income, and with that excess return, they're buying gold. So I believe that they've been the net buyer, the largest net buyer since July.
When you say you believe that, you know that, or
yeah, I think we've seen the data. Mm-hmm. Yeah.
And so, how big a buyer are they relative to the sort of central banks of this world that have been big buyers of late?
Wilfred, I'm sorry, I don't know how to scale it, but I believe there's only maybe one central bank that might have bought more than Tether.
Wow. Because that's not talked about very much.
No, it hasn't. But if you look at one way to simply look at it is look at Tether, USDT outstandings, and gold price since July, and they've been highly correlated. But I think a second factor is we did a study in 2018 showing you that investment preferences skip a generation. So baby boomers loved gold. Millennials liked hedge funds. Mm-hmm. I'm sorry. Baby boomers like gold. Gen X liked hedge funds. But now millennials who are entering their prime working years like what their grandparents liked, which is gold. So I think that there's renewed interest in gold. So those are the two invisible reasons.
Why did crypto not perform last year in a way that gold did?
I think there's a time-based answer. So crypto was outperforming and keeping up with gold until October 10th. But on October 10th was the single largest deleveraging event in the history of crypto, bigger than what happened in November 2022 around FTX. And after that, Bitcoin lost more than 35% of its value, and Ethereum fell almost 50%. So I think crypto lost its tracking to gold because of deleveraging within crypto. Crypto has periodic deleveraging events. It really impairs the market makers, and the market makers are essentially the central bank of crypto. So many of the market makers, I would say maybe half, got wiped out on October 10th. So until we get to the day where crypto is widely mainstream supported by institutional investors, the internal deleveraging events kind of knock it out of the sky.
Does that, by implication, mean that you accept that Bitcoin is not digital gold?
Bitcoin is digital gold, but the universe of people that believe that thesis is not the same universe that owns gold. And so crypto still has I think, future adoption curve that's higher than gold because more people own gold than own crypto. But the path to getting that adoption rate higher is going to be very jagged. And I think 2026 will be a really important test because if Bitcoin makes a new all-time high, we know that deleveraging event is behind us.
And your price target for Bitcoin this year is 250,000.
Yeah, so we think Bitcoin will make a new high this year.
That's driven by what?
Well, it's driven by, I think, the usefulness of crypto increasing. So we know banks, for instance, are recognizing blockchain, and the idea of settlement and finality work really well on blockchain. And then a company like Tether, which is a crypto-based bank, is proving that a bank that emerges natively on blockchain is actually better than a traditional bank. For instance, Tether is expected to make almost $20 billion in 2026 earnings. That would make it a top 5 in terms of bank profits. They, on valuation, might be number 2 only to JP Morgan, twice the valuation of Goldman Sachs or Morgan Stanley. Tether only has 300 full-time employees. JP Morgan has 300,000. So by using blockchain, they make almost as much, well, they make more money than any bank, and they only have less than 1% of the M1 money supply and a tiny balance sheet, and yet it's one of the most profitable banks in the world.
Why did it fall so much back quarter of last year?
Ethereum is the second largest blockchain, and it's, I think, always going to be more volatile than Bitcoin until it becomes similar in size. The crypto world views Ethereum as a price ratio to Bitcoin. So there's this, if you just simply said ETH to BTC, assume Bitcoin is the price denomination of the crypto world. Ethereum's price ratio to Bitcoin is still below where it was in 2021, 4 years ago. And that, compared to 4 years ago, Ethereum is a far superior blockchain because we know tokenization, including dollars are tokenized, is one of the big bets Wall Street's making. I mean, Larry Fink says it's the biggest innovation since double ledger accounting. Vlad at Robinhood wants to tokenize everything. And we already see a lot of effort to tokenize not just dollars, which is stable coins, but credit funds. JP Morgan is launching on Ethereum a money market fund. BlackRock has already tokenized credit funds on Ethereum. So Ethereum is really the blockchain that Wall Street is beginning to use. If Ethereum's price ratio recovers to the 2021 highs and Bitcoin goes to 250, Ethereum would be around 12,000. And Ethereum is around 3,000 today.
What Lee is really setting up here goes far beyond a simple gold versus crypto comparison, because once you move past where money ran during the panic, the more important question becomes why those flows are starting to behave differently than investors expect, and what that says about the next phase of this market. In the next part of this interview, Lee zooms out and connects the dots between policy uncertainty, institutional positioning, and the structural pressures building beneath global markets. This is where the conversation shifts from short-term reactions to longer-term consequences. He explains why gold's breakout may be signaling more than just fear, why Bitcoin's recent weakness could actually be a prerequisite, not a contradiction, for its next major move, and why the market may still be underestimating how disruptive this transition could be. Most importantly, Lee starts to frame 2026 not as a distant forecast, but as a convergence point, where trade policy, demographics, liquidity, and adoption all collide. This is where his confidence becomes more conditional, and where the usual bullish playbook starts to change. If you want to understand what has to fall into place for Bitcoin to reclaim leadership, and why the next leg higher may depend on discomfort first, this next segment is where the real analysis begins.
I think when we look back at the end of this year, I think 2026 will look like a continuation of the bull market that started in 2022, but and really a period when economic resilience is much more visible. But at the same time, there's two, I think, substantial transitions that the market has to grapple with. Maybe three. One is, of course, a new Fed. And, the market always tests a new Fed. And that process of identifying and then confirmation plus the market test can create a correction. And I think that in 2026, our view is that the White House is going to be more deliberate in picking winners and losers. In 2025, that caused a lot of disruption for technology, IT consulting, and for healthcare. And this year, there's a lot more industries and sectors and even countries in the bullseye. And I think that creates uncertainty you can tell by gold's rally. And so I think those two factors can cause a drawdown in 2026.
Those two factors, you said maybe a third.
Yeah. So the third is that the market is still trying to understand how much is priced into AI. And so our view is still a strong narrative. But as you know, there's questions about the longevity, how much energy we really need, data center capacity. And so until the market is comfortable that there's other stronger narratives, which I think there's plenty, like the ISM is turning up. I think housing could recover as rates are cut. But that transition again would cause uncertainty. So I'm guessing that the three collectively could cause a drawdown that feels like a bear market.
So implicit in that is what, like a 20% peak to trough pullback or more or less?
Yeah, it could be 10. I mean, if it's 10, by the way, it's going to feel like a bear market, but it could be 15, it could be 20. But something that maybe brings us to a round trip from the start of the year, because we've started off strong. Maybe we'll be down year to date at some point, but then I think we really finish the year strong. The U.S. does have a favorable demographic tailwind that is in contrast to other countries where the prime age workforce has gone into deficit. In terms of inherited wealth, I think there's a lot more conversations about it that Gen Z and millennials and Gen Alpha, they are set to all inherit substantial sums of money over their lifetime. And it's strange because it does create disparity in wealth. There are going to be some very wealthy Gen Z, Gen Alpha, and millennials, while others are going to be, of course, living their life and accumulating their own personal wealth. And then with regard to AI, I would say that, evidence that we could be moving towards super intelligence is accelerating. And I think there's a lot more progress being made on robots and integration with robots. So those are all things that are going to favor the U.S. And then on blockchain, it's not just BlackRock and Robinhood anymore. Jamie Dimon has publicly stated that he thinks blockchain does fix a lot of problems for financial services. So I think the banking industry is starting to embrace the efficiency of blockchain.
Have we got that good news at the moment that would point to a short-term peak?
It's hard to say. And this is somewhat anecdotal, but our institutional clients aren't that bullishly positioned at the moment. Until we get to the point where both the public and institutions have positioned in a way that good news doesn't make the market go up, I think stocks still have upside. That's why the fact that stocks were good in the first week of January is a good omen, and it looks like we're going to finish the month positive. That suggests strength in the early part of the year. Margin debt is something we can watch, and we've been tracking it. NYSE margin debt is at an all-time high, but it's only risen 39% year over year. Usually for a local top for markets, you want to see that rise 60% year over year. So there's a chance for essentially leverage to accelerate, and then that marks a local top. I think that last year, investors did a fire-ready aim. Whenever they saw the tariff conversations escalate and become uncertain, the market really reacted poorly and fell sharply. I think that this year, markets are going to be a little more measured. So let's say it's half the amplitude of reaction. But then there is still the uncertainty of how the Supreme Court will rule around the tariffs. And maybe if that rules against Trump, then it's going to look like the leverage of the U.S. has dropped. And so the White House might take more extreme measures. That could cause greater uncertainty. But over the weekend, I've been reading the news. I mean, there's some folks suggesting the Supreme Court might actually rule in Trump's favor. So I really don't know. There are implicit threats being made against the Fed, including this DOJ inquiry. But I think there are still voices in the White House that are kind of saying, let's not undermine the Fed completely, because markets know, and market history knows, that the Fed is still the most important entity in the world. And to undermine the credibility and the independence would unleash a lot of uncertainty. We also know Fed Chair Powell's term is up this year. So there's a bit of like let the clock run, because we know that there'll be a new Fed chair. And I think once we have that in place, I think the White House can be satisfied. And as you know, who the next Fed chair can be, I mean, the odds keep shifting. Now it looks like Hassett has dropped as the probable, and Warsh and even Rick Reeder are ascending. So
I guess everyone expects slightly more cuts than maybe the data would purely suggest once that change happens, and or a few more cuts this year. Is that a good thing ultimately for equities?
Yeah, I think it is good for equities in the sense that inflation has been the market's fixation since 2022. Part of it, of course, is because the Fed has been fighting an inflation war, and the Fed wants to maintain credibility by being tight. But when I look at the economic data, and I'm not an economist, I think the underlying inflation is actually much lower than the printed. I mean, a simple thing to point to is something like Trueflation, which is showing 1.8. If you look at median inflation, it's at 1.8. And the thing that's keeping inflation high is housing costs. But housing prices are falling. So the way that housing is measured in CPI is with a lag. So to me, I think there is cover for the Fed to cut. And if housing, as you know, affordability is a problem, we need to do something about mortgage rates. And that is helped by cutting. And even things like consumer installment debt, those can come down with rate cuts. So I think burdens on a lot of Americans can actually ease with Fed cuts.
Meanwhile, attention is now firmly fixed on Davos, where President Trump is scheduled to address the World Economic Forum with a message aimed squarely at global trade, leverage, and what his administration sees as long-standing imbalances in the international economic order. The expectation heading into the speech is clear. Markets are looking for direction, signaling. Now, by the time you're watching this, that Davos speech would have already taken place, and markets would be reacting one way or the other. But what's notable is that even before the president's speech, positioning across financial markets was already turning defensive. Bitcoin spot ETFs recorded nearly $480 million in net outflows in a single session on Tuesday, with BlackRock clients alone selling close to $57 million worth of BTC. Ethereum and XRP ETFs also saw meaningful outflows, while only Solana posted a modest inflow. At the same time, on-chain data showed major crypto intermediaries offloading supply. Coinbase, Binance, Kraken, and Wintermute all reported significant Bitcoin sales within a 24-hour window. In total, exchanges and large holders sold over $7.5 billion worth of Bitcoin, raising serious questions about timing, especially with a high-stakes geopolitical announcement imminent. Wintermute, in particular, drew attention after reports showed the firm selling over $1 billion worth of Bitcoin in rapid succession ahead of the speech. While intent can't be confirmed, the speed and scale of those moves added to the sense that large players were reducing exposure first and asking questions later. Then there's the trade that has sparked the most speculation. A well-known Bitcoin whale, often described online as an insider due to his remarkably consistent timing, opened a new $300 million short position just ahead of the announcement. This is the same trader who became active during October's flash crash, where he reportedly made $180 million in just a few hours by positioning perfectly around volatility. Since then, his trades have repeatedly appeared before major market moves, and he has been 100% right for every position. Some online commentators have speculated about potential political connections, even suggesting proximity to the president's inner circle, but to be clear, there is no verified evidence of that. What is verifiable is the pattern, size, timing, and precision that continue to raise eyebrows across the market. And as if that weren't enough, yet another layer of uncertainty still lies ahead. President Trump is expected to sign a major economic bill today, one that could either calm markets with clarity or introduce fresh questions about growth, trade, and liquidity. So the question now is, does this next policy step restore confidence or extend the volatility? And after hearing Tom Lee's full analysis, where do you stand? Is this a temporary dislocation that sets up opportunity, or the early stages of a deeper structural shift? Let us know your thoughts in the comments. If you found this breakdown useful, make sure to like the video, subscribe to the channel, and turn on notifications. We'll continue tracking how this story unfolds, because what happens next could shape markets well beyond this week. Thanks for watching.